Let's get started. Got a little bit to go over. We're kind of winding down here, so hopefully my lectures, if you want to call them that, discussions, don't drag on quite as long. Just a reminder, the art students have displays up down at the sub right now. That's always kind of fun to go look at. Hopefully I'll get down there today, maybe this afternoon. I'll try to break away and go take a look. So, any other announcements? Anything else going on? We're really getting wound down, aren't we? It's like next week's the last week of regular classes and then finals week. So I would remind you guys that the last time I checked, there was only 3 students who had even started the Comp XM. Nobody at that point, now that was a few days ago, but nobody at that point was even close to finishing. So I know your students and you're just like every other person, you tend to procrastinate things, but might not want to drag it out. It's going to be nice weather finals week, and you're going to be stuck, spending 6 hours doing your Comp XM when you could spend an hour here and an hour there and try to get it done beforehand. Like this weekend's not supposed to be that pleasant, so good time to get that all taken care of. So anyhow, go to work on the Comp XM. Maybe I'll check in a little bit here and see where people are at on that. But let's go over last week's assignment. Honestly, it wasn't real good. Mikkel asked if I had corrected it, and I have. I've gone through, I think I've looked at everybody's, and I've put grades in. I just haven't published the grades yet where you guys would be able to see them. So I'll do that here probably when I'm done here. But I think I purposely put it off because I kind of wanted to go over it because, like I said, for whatever reason it was so-so. But question number 1 was on the cash flow, why did Digby have a positive number in the plant improvements category? And I got answers all over the place, and there's only one real possible answer, and that is that it sold capacity at a gain, right? And there's only one way that you could achieve a positive number there. Why do I mean at a gain? Remember when we talk about finances and we go through our financial statements, those types of things, we've got depreciation, right? Okay, if you sold capacity at the start of the game, you sell capacity at 65% of what you pay for, right? So if you pay $100 for capacity or it's on your books originally at $100, right? You sell it at the beginning, you get $65 for it. You've maybe depreciated it that first year a little bit, maybe $10 we'll say, so it's down to 90. You're selling it for $65. You have a loss of $25 per unit of capacity, okay? The opposite's true then kind of as the game goes on. So you've depreciated it down to $50, right? First, I'm talking about cash flow here, not on the income statement. I'm sorry. I'm talking about the income statement, not on the cash flow. So I guess I got to go back. On the cash flow, it wouldn't matter. If you sell capacity, it's going to be a positive for cash, so forgive me. I kind of got off there. I was talking about the income statement and how you could do it as a gain or a loss. So I need to take off of there that you're just selling capacity, because it would not matter if it was at a gain or a loss on the cash flow. Apologize for that. Okay, but on the income statement, it makes a difference. If you sell it later on, you can actually get a gain, and it can actually contribute to an income there, probably under the other category. So 2 was, how much money did Andrews leave on the table in the low-end sales profits, after-tax profits? Some people did pretty good on this, others varying degrees, and some still kind of lost. Okay, some people did the math okay, and for some reason got wrong numbers even to start with, as I kind of looked at it. But if you look just at acre, okay, acre had a potential of 22.6. Its actual was 15.4. So 7.2% potential demand that it left on the table. If you take that times the total industry demand, which was 18,255,000 units, it could have sold an additional 1.3 million units. At $18, that was its selling price. Okay, so it lost sales were a little over $23.5 million in lost sales, huge. The marginal variable costs were, and why do I say marginal? You guys understand what I mean when I say marginal? Marginal cost is those costs that were the last one produced. Okay, that's what it cost to make the last one, and that's what it would be on the production report that's up above. That gives us our marginal. Because the ones that you had in inventory that you already sold from last year, the cost on those may have been different, and that may have a different effect on your contribution margin. But the marginal cost is on the last one. So the ones you didn't sell would have been affected by the marginal cost, unless you had so many in inventory from the last one, on and on. I could make it even more complicated. Anyhow, the marginal costs were $10.12 per unit, so times those same number of units, say that my total variable costs were about $13.3 million, right? Okay, and I subtract that from the lost sales, and I come up with about 10.4 million that I'd had in potential gross profit. Tax rate was 35%, has been. Okay, so my taxes on that, 10 million, would have been about 3.6 million, and thus my potential profit, after-tax profit, net income that I could have made had they, or that Andrews could have made had they sold, okay, their potential would have been about $6.7 million, which would have been substantial. Right, would have been substantial. The last one was pretty much a wipeout. Okay, what are some of the hidden costs associated with excess capacity? Okay, I didn't get a lot of good answers on this one. The things that would happen with excess capacity, and by excess capacity, I'm talking about not using it to the twice, right? Okay, double shift up to 200%, or it only lets you go to 198, I think, but up to that 198 or 200%, if you're not using it up to 200%, you have excess capacity. Okay, and the costs are these. One is interest. Okay, because you could sell capacity, right? You could use it to pay down debt, or if you didn't have any debt, let's say you were debt free, but you still had that excess capacity, you'd use that for investments then, right? You'd use that for investments. Okay. Two would be depreciation. Because it's a cost, right? So you've got that capacity and it's sitting on your books and you're depreciating it every year, and so that's a big expense, right? You sell capacity and you get rid of that depreciation on your income statement for at least that capacity that you sold. C is some maintenance. You've got some maintenance costs. I don't know how the game calculates maintenance, so I don't know what those costs, I don't know that I can calculate those. I could come back and calculate, depreciation, probably interest, I could calculate that. If you decide to invest in automation investment is based on the amount of capacity that you have, right? And so your investment in automation would be cheaper, less expensive, okay, if you had a smaller amount of capacity in those particular units, right? So that would be a huge thing. The other thing, I probably should add this, and I might, before I publish this, I guess I should. You're also, if you've got capacity, if you've got excess capacity, that's excess assets, so it's going to affect your ROA. Okay, and if it's excess assets, that means that it's also excess equity, possibly. If you sell, that's kind of a wash, because if you sell capacity, you're going to get cash, right? Okay, but if you were to disperse the cash because of that excess capacity, you could lessen your equity, which would have the effect then of what? Increasing your ROE, right? Okay, so it's got a potential effect certainly on ROA, but also potentially on ROE. So, okay, that one didn't go over so well. So, and that's a huge deal. Okay, as you see when we look at the companies here that are tending to be victorious, they have. They're using their capacity probably more efficiently and effectively than the other companies. That's been true of this game, okay? So many teams have tried to, through the years, tried to minimize their labor costs by not having that overtime, but they don't realize that these kind of hidden costs are out there when you have that excess capacity. And those hidden costs, which are tough to calculate, and they don't necessarily show up, and they're not necessarily in the front of your mind, they're huge. Okay, those are huge costs. Questions about that? Okay. Let's go to the round. See what happened. This one was kind of fun. We got some. Oops, I got to get to round 7. I'm sorry, that's not round 6 because that's what the assignment was about. So round 7. We got sales approaching over 300 million. Wow. $361 million was the high sales for Chester. Again, Chester though still has second lowest. Okay, the two teams with the most sales have the first and second lowest contribution margins. That's just not that unusual, right? That's just not that unusual. Teams that would strive for market share sometimes have smaller contribution margins, maybe because they're giving it up on price. That's possible, right? Or maybe because they're investing money in marketing and those types of things versus investing money in automation or things that might reduce their costs. Okay, they could also be selling more in the high ends versus the low ends, which tend to be the high ends in this game. At least tend to have a little lower margins, gross margins or contribution margins. Okay, so it could be any number of those things, right? Baldwin ended up with a little emergency loan, not too much. Profits ranged from, look at that, Digby had the highest profit, 45 million to 44 million for Chester, so that's pretty close, but look at the ROE. ROE swapped a little bit, right? Chester ended up beating Digby in terms of ROE 38.2 to 35.2. You're going to have another question on this week's assignment about ROE, okay? And it's really going to focus on what might Digby have done, sorta. Question's a little different than that, we'll talk about it, but what might Digby have done to have improved their ROE? And we'll talk about that when we get down to the balance sheet a little bit. Okay. Contribution margins, again, they actually, last week we had some that were approaching 50, and we actually fell off a little bit, it looks like, this week overall. Maybe the competitive pressures, maybe some teams decided to try to compete more, get more sales, get more market share. I'm not sure, we could really dissect it and try to figure those things out, but we actually had a little bit of a decrease in terms of overall contribution margin, I think. When I look at it, it looks like overall contribution margins came down, so kind of interesting. Stock market summary. Got teams, heading up $200 a share. It's getting to be pretty good, right? What'd you guys start at? $25 a share, roughly? So here you are at the stock price of about $200 a share. Where are we at? Yeah, Chester's just south of $200 a share, 197. So earnings per share. No surprise here that even though Chester and Digby had a little bit more earnings, but remember early on, Digby was selling stock. Million shares difference still, between the two, and they both bought back a lot of stock, this round. But 1 million shares roughly difference here, so it's no surprise then that there's a substantial difference in earnings per share, right? Okay. Another way to look at this is that, Digby made more money, but they're sharing it with far more people. In one sense, more shares outstanding, at least. It wouldn't necessarily mean more people, but they're distributing that to a lot more people. So as a shareholder, I'm greedy, right? I want to share the profits of the company that I own with as few people as possible, okay? Because I'm a greedy bugger, and so I want to make just as much money myself as I possibly can. Debts, again, the two computer teams, a lot of debt. Chester didn't have any debt last time. Look at that, though. Their credit rating dropped from AAA to BB. Wow. So they went from the best credit rating possible to what we would call junk. Okay? Junk bonds are anything that are rated below BBB, so you know. And junk bonds are anything rated below BBB. So everybody's junk right now except Digby, surprisingly. We see teams, this surprised me a little bit. Digby didn't invest any. They had, though, remember they sold capacity. They were the positive last time, okay? But every other team still investing some money in plant improvements. That surprised me a little bit. Oftentimes as we get towards the end, teams will tend to suck it up a little bit. Your computer teams won't. Okay, they don't know that this thing ends after 8 rounds. Okay, that's one of the reasons human teams will tend to beat them sometimes in the last few rounds too, because the computer's not playing this game as if it's got a final round. It's playing the game as if they're going to go on forever. Humans tend to look at the end and say, I wonder if there's some things that we could do to really enhance our profits these last couple of rounds. Profits, cash flows, those types of things. So it gets played a little bit differently. Look at the dividends paid. I think one of your questions might be, why did Chester pay a $55.8 million dividend? $55.8 million in dividends. I think I went back and calculated, okay? And if I'm not mistaken, if you'd have bought, at the start of this game, if you would have bought, we should go back and look at round 1. Maybe one of you guys go look at round 1 and tell me what the stock price was at, I'm sorry, at round 0. Okay, at round 0. Okay, because a $55 million dividend has to be about 30 bucks a share. Okay, should have been 30, 31 bucks a share, something like that. Okay, my suspicion is, I'm pretty sure I'm right, is that if you owned Chester, you just got paid a dividend. If you'd have bought Chester right at the very start, you just got paid a dividend that was equal to or exceeded your original purchase price. 34, 36 was. Are you looking at close? Or? Yeah, say at round 0. Yeah. Everybody was at 34. Everybody's at 34 bucks, and Chester just paid a dividend that was pretty close to 34 bucks. It looks like it was about 30. Maybe a touch over 30, but right at about 30 bucks. So you just got paid back basically everything that you had invested in the company. You still own the stock, right? You still own the stock. The stock's worth 200 bucks a share. So your investment just got reduced to 0 basically, and yet you've got a stock that's worth 200 bucks a share. That'd be fabulous. That'd be pretty good if we could do that in real life. You guys could all retire when you were about 30 or 35 or so, but yeah, real life doesn't always work quite like that. So huge dividend. Purchase common stock, so we see teams buying back stock now. Chester aggressively, Digby aggressively, the two computer teams not so much. Getting rid of some debt. Interestingly, and maybe appropriately, Digby got rid of some debt. Even in spite of that, if you bounce down here, Digby's got $75 million in cash. Huge cash, right? That'll be a good question. I might add that I wasn't done having enough questions, but why would I say, like I've said all semester, that cash at this point can really be a killer? It could just be a killer. Okay, it can really wipe you out. Cash just killed Digby here. Okay, having $75 million in cash, wow. Okay, horrible. I know that. Doesn't that sound just terrible that I would say that you're sitting on all that cash, but it killed them. Okay. Erie and Ferris, lots of cash. Chester's quite a bit of cash, but maybe more reasonable. You definitely want cash because you want to be able to pursue investments. You want to be able to pursue different things like that. So you don't want to be completely broke. You don't want to run your account completely dry normally. I would say early in the game, in a game like this, you might want to, but later on, you do want some cash for different things. Okay. Total fixed assets. Ooh, look at that. Erie and Ferris, huge. Digby had drawn down their fixed assets, but their total assets, pretty good size. Look at how big Ferris is. Man, oh man. Chester, pretty good size. Digby, pretty good sized. Total equity, there again, look at that. 130 million for Digby, only 115 million. Sorry, for Team Chester. I don't think that changed much from last year for Team Chester. Even though they made $45 million or $44 million, I don't think their equity hardly changed whatsoever. If I remember right, last round they were 114 million, something like that. 118 million. Might have actually gone down a little bit. Crazy. Wow. What'd that do for them? Might be one of your questions. Oh, let's see. What kind of cool things? Not a lot of investment going on. A few of you are still investing in some TQM. Getting some final little goodies from that. And that's fine. It's still effective. Again, if you were playing for the longer term, you might continue to make, some small investments in TQM just to kind of continue to keep that up to date and whatnot. But as an end game, we're getting to the point where it probably won't make a lot of sense to invest in TQM. Your return won't come back fast enough to pay for your investment. Anything else? Not a lot other exciting on those other than what we saw up above. So again, capacity, lots of excess capacity still. Ferris has lots of excess capacity. Andrews a bit. Chester, again, Chester not so much. Baldwin way too much capacity for what they're okay. Either they've got the least amount of capacity of any team, but their production is even far less than that, right? Which we're just talking extreme excess capacity. Either they need to produce way more if they could sell it, or cut back. But they had a decent amount of inventory left over, if I remember right. Bless you. Andrews, again, not much inventory at all. Might be a problem there. We'll take a look at it. Baker or Baldwin a little bit. Chester, I think, had the most inventory. Again, looks like most of that's tied up in these two items here. A lot of not much inventory for Erie. Decent amount, kind of spread all over for Ferris. That's not bad inventory management there for Ferris. You look at that and you say, they got some inventory in every category, but it's pretty well spread out. You want a little bit of inventory because it means that then you didn't leave anything on the table, right? Like, when we just did this exercise last, your deal was how much did Andrews leave on the table here? Remember last time it was only 7.2%. Here it looks like it's about 11%. Okay, so another 50% more, so they probably left a net profit. Then you got to figure 10, 11, 12 million, probably $11 million or so, 10.5, $11 million of net income on the table by not producing enough. And maybe they didn't have the capacity. I don't know. We go up and check. It was acre that was the problem. Yeah, they could have made. Certainly they could have made some more. But they had inventory left there, so maybe it wasn't acre. Maybe it was able this time. That left a lot of capacity on the table, or that left some on the table. Looks like it had to have been able. And yeah, they could have made substantially more. Could have made 36, so you could have made another 16, which probably was about what you missed out on. So had you guys maxed out there on able, I'm guessing that it had to be able. Another 10, 11 million. God dang, what would that have done for you guys up here? So your net profit would have been about 27 million, so about 50% higher. So your ROE would have been about 39. Would put you into probably the lead. Now that's just off the top of my head math, or back of the napkin type of math, so I don't know. But it might have put you into the lead in terms of ROE. Had you, and that's probably not quite right. Even doing the back of the napkin math, because if you'd made that much more money, you would have increased your equity by an equal amount, and so the impact on your return on equity might have only got you up there. You'd have still been competing pretty closely, with the two head teams had you done that. So probably would have been in the mid-30s at least. Wow. Okay. That was the traditional segment. I'm sorry. I was talking about the wrong segment. So in the traditional segment this time is where you guys gave up about 12% of the market. So I'd have to redo the math, but that's still about 1.6 million. Must have been your Atom product. So you could have sold 1.6 million more at about 25 bucks. So you had about 40 million in sales that you missed out on. What's your marginal cost on those? So you missed out on 40 million in sales. Did I say it was Atom? Yeah. Cost of about 17 bucks. The contribution margin is fairly low in that 30. Let's just use that. So you missed out 40, still about 12 million before tax. So probably about 7-8 million again in after tax that you guys probably missed out on there. Sorry. Low end, Erie left some on the table. It's like other teams kind of took advantage of that. So sorry I mixed those up, the low end and the traditional. Erie's kind of dominating, but that's where they focused, right? Digby left some money on the table here in the high end. Chester and Ferris took advantage of that. They're the only three teams competing there. They're still making plenty of stock, though. Size. And what was it, Adam? So Adam had 12.5 and could have had 19. Their ace had 12.3 and could have had 17, so it would have been combined. You guys missed out on both of those products in terms of potential and actual. Real sorting it out. Some of these are gonna, they're pretty close to gonna have to either quit selling them, or they're gonna leave if they get out of that dotted line, they'll quit selling. Period. Right. So you got to stay within at least the dotted line. If you're outside the dark line, it affects the sales, but kind of so-so. Cedar's on the edge there, getting out of the dark line. So, will it last another year? I don't know. That's going to be some interesting decisions there. Because if you move them, obviously, then they become younger, and age is a big thing in the low end, right? Okay, so you might have to move it, because otherwise it might fall outside. You'll have to see where it falls. 'Cause again, even if it's outside that line a little bit, you may be better off having an older product that's just outside the dark line versus spending a lot of money and moving it up. And tough decisions. Wow, glad you guys have to make those, not me. HR, not much investment going on in HR, maybe a little bit. TQM, like I said, there was a little investment there, so cool, fun round. Who won? This was close. This one was as close around as we've had. You could tell just when you looked right at it. So earnings per share, Chester, okay, which is the big one. And again, that's simply a matter of them not ever selling stock. Digby would have certainly won earnings per share had they kind of followed along with Chester and not sold any stock and bought back stock recently, which they're trying to do now. But you're limited as to what you can buy back. Did you guys buy back the max, Mikkel? Yeah. So they could only spend $14 million in stock buybacks. So you're kind of limited in what you can do there. And Digby bought back $12 million. Might have been their limit too. I'm not sure. So ROE, okay. Digby came close there. Okay. Do you suppose their $75 million in cash had an effect on that? Oof. Contribution margin, Erie, followed by Baldwin, followed by Digby. Is that the one you said that you thought my math was wrong on? I'll have to look at that. As you can see, my formulas get to be a little bit.
It could just be like the different teams, though, but I think we were second to last. I think Ferris was last.
Also, I might just have those two kind of backwards. Yeah, Ferris was last in contribution margins, so. Wonder why I screwed that up. Stock price. Chester had the biggest increase in stock price. Profits, so Digby had the biggest profits. Digby also had the best cash flow. We got 94.5 to 91.5, so it depends on if Chester had any deductions for, they borrowed a lot of money, so maybe they had deductions for leverage or working capital or something. No emergency loan. No leverage deduction. Baldwin had a leverage deduction. And no working capital. So that's the only deduction that we had this time was Baldwin for the leverage. So Chester was victorious. Two teams beat both of the computer teams, and then Andrews beat Ferris. Andrews would have, again, the potential. Actually, you guys would have creamed Erie probably at least, and maybe been a lot closer up here too. You never know what effect that would have. if you guys met your actual, it's one thing to add up the effects that would have for your team, the positive effects, but it obviously would have had some negative effects on the other teams too, and so you don't know what that does in terms of the game, right? So yeah, while your guys' ROE might have only gone up to 33, you might have brought down Chester's ROE to 34 or something like that, right? Or Digby's or somebody. So, yeah. So, doggone it, I don't get to read Chester's homework this time. Shoot. Okay, let's, this week's assignment. I think I'm going to add one. My final results, winners had been different. Had Digby paid total dividends in the amount of, and the question is why, and then I want you to show me how. Bless you. Then the confusing question. Okay, this one I'm looking for a little help on. I don't know if there'll be a wrong answer, but what's Baldwin's strategy? Okay, so take a look at the things they're doing and whatnot and kind of try to tell me what their strategy is. And then 3, why did Chester pay out $55+ million dividend, 55.8 or something like that, 55 point, some god-awful amount of money, right? Just a huge, huge special dividend that they paid out. We'd call that a special dividend in most cases. A lot of companies have regular dividends that they pay out. I go back, there was a time Microsoft here, it's been 10 years or so ago, they actually paid out I think it was a $3 special dividend, which is a lot of money because they have about 10 billion shares out, so it was a $30 billion dividend that they paid. It actually, they had to calculate that when the government does their calculations for GDP, they had to take that into consideration because they called it a minor stimulus, just like as if the government had, sent money out. So Microsoft paying a $30 billion special dividend was considered a minor stimulus. So in companies right now, Apple's sitting on $200 billion in cash or something like that. I think Microsoft still has $70, $80 billion. Maybe it's 100, I don't know. Unfortunately, a lot of that money's overseas. Again, with these big companies, a lot of that money's overseas. And it costs them to bring it back, so they probably won't, unfortunately. So, 4. Oops. What are the impacts of Digby's $75 million dollar cash balance? There might be pluses and minuses. Okay. Obviously, I would think that the minuses would probably outweigh the pluses in a case like that. So, okay. Any questions? Questions about the round? We've got one round left to play on Tuesday. It is the last round. Okay. You guys have the Comp XM to finish. Yes, we'll meet Thursday because we'll want to go over the round a little bit, but also the assignment because you will have one more assignment, right, for round 8. So we'll get that distributed next Thursday, and then that'll be due for finals week along with your Comp XM. Okay. What else? Like there's something else I was going to say. Hey, make sure you get to work on the Comp XM. Oh, I was going to say, yeah, people will posture for the final round. Okay. Nothing we can do about that. Okay, so you'll posture. There are some things that you can do. Some of the things you might think are correct, though, aren't necessarily correct. So what I would tell you, if you're going to do some posturing here and do some things for the final round, make sure you think them through a little bit. Okay, make sure that you think them through a little bit and what the total impacts are going to be, because some of the things you think might be helpful might actually be kind of hurtful, because you got to really think through the impacts on the financial statements, profit and losses, and those types of things. So, okay, or you just play the game straight. That's fine too. Okay, I would say that most years the teams that have played it straight, that have done pretty well throughout, and they do fine the last round, they just play it straight, pretty much straight, they do fine. So, questions? Nobody wants to launch? Okay, I'm done then.